My name is Tan Wei. My metric number is 29174. I would like to present about quiz 3. Question number 1 clearly explains the terms currency strengthening, which is appreciation, and currency weakening, which is depreciation. Provide a realistic scenario using RM and Australian dollar for each case. Here's the answer for the question number 1. So when the currency appreciates, so it increases in value relative to the other currency. So this means the currency can buy more of the other currency than before. So for example, like suppose the exchange rate was 1 ringgit equals to 30 cent dollar. So after some time, due to strong Malaysian exports and rising investor confidence, so the rate already changes to 1 ringgit equals to 35 cent dollar. So previously 1 ringgit can bought the 30 cent dollar, now it's buy 35 cent dollar. So the Malaysian ringgit has appreciated against the Australian dollar. Malaysians find it cheaper to import goods or travel to Australia. Australian tourists or importers find it more expensive to buy Malaysian goods. So when a currency depreciates, it lost value relative to another currency. This means that the currency can buy less of the other currency than before. So for example, like suppose the exchange rate with 1 ringgit equals to 30 cent dollar, but due to the political instability or high inflation in Malaysia, so the rate changes to 1 ringgit equals to 25 cent dollar. Previously 1 ringgit bought 30 cent dollar. Now only buys 25 cent dollar. So the Malaysian ringgit has depreciated against the Australian dollar. Malaysians will find Australian goods more expensive. Australian buyers will find Malaysian exports cheaper, which may boost Malaysian tourism or export. Now, the second question is what is the fundamental distinction in the economic insights provided by a nominal exchange rate compared to a real exchange rate? It illustrates with a clear RM or per USD examples how Malaysia's real exchange rate could depreciate even if its nominal exchange rate against the USD remains stable or experience a slight appreciation due to differing inflation. So, answer for question number 2 is the fundamental distinction between the nominal exchange rate and the real exchange rate lies in what they measure. The nominal exchange rate indicates how much one currency can be exchanged for another without adjusting for price level. Where the real exchange rate adjusts the nominal rate by taking into account inflation differentials between countries, thereby reflecting the true cost or competitiveness of goods between nations. So for example, like suppose the nominal exchange rate is stable at 1 USD US dollar equals to 4 ringgit 50 cent, or even slightly appreciate to 4 ringgit 45 cent, so suggesting a stronger ringgit. However, if Malaysia's inflation rate is significantly higher than that of the US, Malaysian goods become relatively cheaper in real term compared to US goods. This is because the prices of Malaysian goods have risen faster domestically but not enough to offset the stronger ringgit, resulting in the real depreciation of the RM. As a result, Malaysia exports become more competitive internationally despite the nominal rates showing little or no depreciation. The third question is about clearly distinguish between the spot market and the forward market for foreign exchange based on their operational static characteristic and typically used cases. Provide a specific examples of how a Malaysian manufacturing company planning to import essential machinery from the US in the 3 month might utilize the forward market for RMB/USD. Explain why this company might prefer the forward market over waiting to use the spot market at the time of payment. Here's the answer for question number 3. So spot market refer to a market where currencies are bought and sold for immediate delivery, typically within 2 business days. So in terms of operational characteristics, so the spot market is based on the current spot exchange rate. In terms of use case, if the spot market is suitable for immediate transactions such as tourists exchanging money or companies making urgent international payment. So forward market refer to the a market where a contract is made today to exchange currency at a specific rate on a future date. So the operational characteristics for market locks in the exchange rate in advance regardless of future fluctuations. The use case of forward market is used by business investors to hedge against currency risk for future interaction. So for example, a Malaysia manufacturing company plans to import machinery from the US in 3 months with a cost of 500,000 US dollar. So the current spot rate is 1 US dollar equals to 4 ringgit 50 cents. So but the company is concerned that the ringgit might depreciate over the next 3 months. It's moving to the 1 US dollar equals to 4 ringgit 70 cents, increasing the cost in ringgit. So to avoid this risk, the company enters into a forward contract today to buy US dollar 5,000 ringgit in 3 months at a fixed forward rate of 1 US dollar equals to 4 ringgit 52 cents. So this lock the total lock cost at R 200 2,260,000, providing cost certainty. So the by using the forward market, the company can avoid exchange rate risk and uncertainty, protect its profit margin as it knows exactly how much it will pay in RM, and improve budgeting and financial planning compared to the spot market, which will expose the company to potential high costs if the ringgit weakens. So given the data below, determine the area between the RM and Japanese yen in both the initial and final period. Discuss how the result reflect the trade competitiveness with Japan. So when we using the using the formula, we can found that the initial RER is the 3.99, so the final RER is the 3.8. So the real exchange rate fell from 3.99 to 3.8, so indicate a real depreciation of the RM relative to the Japanese yen. So this means that even through the nominal exchange rate also decrease in the relative inflation of Malaysia were higher than Japan, which offset part of the nominal movement. As a result, Malaysian goods become relatively cheaper compared to Japanese goods in real term. So question number 6. Suppose a Malaysian investor considers investing 150,000 either in the UK at 3.2% or in Malaysia at 2%. Current exchange rate is 5 ringgit and 50 cents and expected to become 5 ringgit and 30 cents. Calculate the final Malaysia returns in both cases and suggest a better option. So here is the answer for question number 6. So the local investment in Malaysia record a total of 153,000, and the UK investor return offer an amount of 149,171 ringgit and 89 cents. So the UK offers a high interest rate. Expected appreciation of the RM reduce the Malaysia value of the foreign investment. Therefore, the local investment in Malaysia is the better option in this case. So this is the question number 7, which is explain what it means to hold a long vs short forward position in a context of foreign exchange contract. So give example involve the ringgit over pound. So this is the answer for the question number 7. So which is the long forward position refers to holding a long forward position means you agree to buy a currency at a specified price on a future date. So in the ringgit Malaysia per pound term, if you have a long forward positions on the ringgit per pound, you are agreeing to buy ringgit by paying pound in the future at a predetermined rate. So suppose a Malaysian company expects to receive 1 million pound in 3 months, but wants to lock in the current exchange rate to avoid risk from currency fluctuations. It enters into a forward contract to buy ringgit at a fixed forward rate of 5 ringgit per pound in 3 months. At maturity, the company will buy ringgit Malaysia by paying 1 million pound at 5 ringgit and 50 cents. So they get 5.5 million regardless of the spot rate. If the ringgit Malaysia weakens, the company benefits because they lock in the better rates. If the ringgit Malaysia strengthens, which is the spot rate is above 5.5. So the company would have been better off not locking it, but they are obligated to buy at the forward rate. So now the next is about the short forward positions. Refer to holding a short forward positions means you agree to sell a currency at a specified forward rate on a future date. So if you have a short forward rate on ringgit per pound, you are agreeing to sell ringgit and receive pound in the future at the forward rate. So a British exporter who expects to receive 5 million in 3 months might want to lock in the current exchange rate to avoid risk. The exporter enters a forward contract to sell ringgit at a fixed forward rate of 80 cents pound per ringgit in 3 months. At maturity, the exporters will sell 5 million and receive pound 900,000 pound. If the ringgit Malaysia depreciate against pound, which the spot rate is fall below 18 cents, the exporters benefits because they lock in a higher pound amount. If ringgit Malaysia appreciates, the spot rate rise above 18 cents, so the exporters losses a potential gains, but it is protected against risk. So this is question number 8. The spot rate is 3 ringgit and the 9 month forward rate is 3 ringgit and 5 cents. So calculate the annualized forward premium or discount and state whether ringgit Malaysia is trade at a premium or discount. So this is the answer for the question number 8. So first we need to calculate the forward premium, which is using the F minus S over S, and we can get the answer is 1.96%. So since the F is larger than S, so the forward rate is higher than the spot rate. Next, we have to calculate the annualized premium, which is using the forward premium divided by T, which is equals to 2.23. So if the F is larger than S, which is the forward rate is larger than the spot rate, so the best currency is trading at a forward premium. So if the forward rate is less than the spot rate, so the best currency is at a forward discount. So the RM is trading at an annualized forward premium of 2.23% against the dollar. Question number 11 is a Malaysian exporter is to receive the euro 100,000 in 6 months. The forward rate is 5 ringgit and 8 cents, which while the expected spot rate then is 5 ringgit and 20 cents. Calculate and compare the RM proceeds under both scenarios and determine if locking in the forward contract was beneficial. So here is the answer for the question 11. So by using the forward contract, so they can gain 508,000, but if they use the expected spot rate, they can get a 520,000. So the forward contract is considered beneficial. This because if the expected spot rate accurate, so the exporter will have earned 12,000 more. But however, the forward contract can help eliminate the exchange risk. So the question 13 is define the clearly absolute purchasing power parity and relative purchasing power parity. Highlight the main difference between these. So this is the answer for the question 13. So the absolute purchasing power parity refers to exchange rate between two currencies equals the ratio of the price levels in the two countries. In other words, a basket of goods should cost the same in both countries where prices are converted. So the next is the relative purchasing power parities refer to the rate of the charge of exchange rate and the price levels rather than their absolute levels. It states that the percentage change in the exchange rate over time equals the inflation differential between the countries. So now let's take a look at the difference between the APPP and the RPPP. So the APPP is more focused on absolute price levels, but the RPPP more focused on changes in price levels over time. So APPP in terms of time dimensions, it is more static, but the RPPP in terms of time dimension is more dynamics. So APP in terms of exchange dimensions, exchange rate relationship. So the exchange rate ratios of price levels, but the for exchange rate ratio in the APPP show the exchange rate change inflation differential. So the APPP assumptions is identical basket of goods and no transportation cost. So the APPP, the RPPP assumption is allows for short-term durations. So this is the question 16. So a laptop is sold for 4,500 in Malaysia and US 1,000 US dollar in the US. So the market exchange rate is 4 ringgit and 60 cents per US dollar. So test if APPP is valid based on this data. So the price in Malaysia is 4,500 and the implied price is 4,600. So the actual Malaysian price is which is 4,500 is slightly lower than the implied price which is 4,600. This means that the laptop in Malaysia is cheaper, so the APP does not hold exactly. So question 17. So a book costs £40 in the UK and $60 in the US. If the current exchange rate is £1 equals to $1 and $40, explain whether arbitrage opportunity exists based on APPP. Calculate the no arbitrage exchange rate. So this is the answer for the question 17. So the implied exchange rate based on the APPP is calculated through the price US divided by price UK equals to 60 over 40 and equals to $1.5 over pound. So the current exchange rate equals to 1.4, but the no arbitrary exchange rate is 1.5. So since the actual exchange rate is lower than the APPP rate, so the British pound is undervalued. So the which means that the arbitrage operation exists. So we can buy the book in the UK for the £40 by converted £40 to US dollar at the current rate is equals to 56 US dollars. So buy the books in the UK for $56 worth of pounds, but it costs $60 in the US. Book is cheaper in the UK, so you can buy in the UK and sell in the US for profit. So this is the question number 20. So it's a jacket cost 100 in Switzerland and $90 in the US. If the current exchange rate is 1 equals to $0.85, excess if arbitrage exists, what should the exchange rate be to eliminate the opportunities? So this is the answer for the question number 20. So first we have to find is the implied exchange rate based on the FPPP, which is by 90 divided by 100, we can get this equals to 0.9. So the actual exchange rate is 0.85 is less than the implied exchange rate is 0.9. So the Switzerland currency is undervalued. Well, first we have to convert the Switzerland currency into the US dollar, which is equals to the $85. So the jacket price is much more cheaper in Switzerland, which is cost only $85. And the jacket is cost $90 in US dollar. So we can buy in Switzerland and sell in the US for profit. So if we have to eliminate the crash where use is E equals to 0.9 US dollar over CFC. So the jacket cost the same in both country converted. Uh, Question 22. So using a demand and supply concept in the foreign exchange market, explain how the Ringgit Malaysia per Japanese yen exchange rate is determined. Include the level graph to support your explanation. So based on the curve above, we can find that the demand curve is down sloping because when the exchange rate decreases from ER0 to ER1, so Malaysian currency appreciates. Japanese goods become cheap. Malaysia increase the quantity demand of Japanese yen to buy Japan goods. So the supply curve is upward sloping because the exchange rate increased from ER0 to ER2. So the Japanese currencies appreciate. So Japan consumer purchase more ringgit Malaysia. So they exchange their Japanese yen for ringgit Malaysia. So there is an increase in the quantity of Japanese yen supply. So at the ER2, the quantity supply of Japanese yen is greater than the quantity demand of of the ringgit Malaysia, which shows an excess supply. So the Japanese yen will depreciate to the point at E0 with which no surplus at E1, at ER1. So the quantity demand of the Japanese yen is greater than the quantity supply of Japanese yen, so which shows an excess demand. So the Japanese yen will appreciate to the point at which there is no shortage at the point E0. So there is a demand equals to the supply, so there is an equilibrium at E0, which is ER equals to ER0 and Q equals to Q0. So this is the question number 24. Okay, given the Malaysia annual interest rate is 2.5%, UK's annual interest rate is 4.5%. The current spot exchange rate is 5.3. Using the uncovered interest parity, calculate the expected future spot exchange rate after 1 year. So this is the answer for the question number 24. We can get the answer by using the formula, which is the exchange rate equals to spot rate times the 1 plus the domestic interest rate over 1 plus foreign interest rate. So by putting the number, we can find that the answer is 5.1975. So the expected future spot exchange rate after 1 year is 5 ringgit and 20 cents. So ringgit is expected to appreciate. So this is the last question, which is the question 27, which is the derive the conditions for real interest rate. So no, sorry, the real interest parity by integrating the Fisher equations, relative purchasing power parity, and uncovered interest parity. So clearly explain each step and its economic implications. So this is the answer for the question number 27. We have to find the Fisher equations, which is the nominal interest rate equals to the real interest rate plus the expected inflation. I say that home is in Malaysia and the forex equals to US dollar US. So the Malaysia here is the equations. The Malaysia nominal interest rate equals to Malaysia real interest rate plus the Malaysia expected inflation. And the second equation is the US nominal interest rate equals to the US real interest rate plus the US expected inflation. So next we have to find is the relative purchasing power parity, which is the expected E or the spot rate, future spot rate minus the current spot rate or current spot rate equals to the expected inflation in Malaysia minus the expected inflation in the US. So the expected rate of depreciation of the IM is equals to the inflation differential. So the next we have to find is the uncovered interest parity, which we have the expected future spot rate minus the current spot rate over the current spot rate equals to the current nominal interest rate minus Malaysia nominal interest rate minus US nominal interest rate. The expected exchange rate equals the nominal interest rate differential. Now we have to combine for the UIP and the RPP, which is the first is the Malaysia nominal interest rate equals to US nominal interest rate equals to the Malaysia expected inflation minus the US the expected inflation. So by substitute the Fisher equation, we can get the Malaysia interest rate plus the Malaysia expected inflation minus the US interest rate, real interest rate plus the US expected inflation equals to the Malaysia expected inflation minus the US expected inflation. So from there we can get the real interest rate of Malaysia minus real interest rate of US equals to zero. So when we need to apply for the real interest rate parity condition, which is the Malaysia real interest rate equals to the US real interest rate. So the RIP states that real interest rate shows equalized across countries. So it implies the perfect capital mobility and no arbitrage in real returns. So if the RIP is how investors are indifference between countries after the adjusting for inflation.